What's going on YouTube? In this video, we're talking about Solar Edge, ticker symbol SEDG. Oh boy, year to date, this company is down 54.6%. Over the course of 1 year, down 45%. We're gonna go through their financials and see how this company is holding up financially with the economic slowdown in the solar industry. Actually, real quick too, Solar Edge obviously is a solar company, designs, develops, and sells direct current optimized inverter systems for solar photovoltaic installations worldwide. It operates through 5 segments: solar, energy storage, e-mobile, critical power, and automation machines. The company offers inverters, power optimizers, communication devices, and smart energy management solutions used in residential, commercial, and small utility scale solar installations. It apparently also has a cloud-based monitoring platform that collects and processes information from the power optimizers and inverters. Obviously, rundown of what they do or what they're involved in. So we have their revenue, gross profit, net income over here. Our revenue growing, our gross profit somewhat growing, right? Net income is not. Our net income is relatively flat to now somewhat declining. And this isn't a big number. We're doing $3.6 billion in revenue, and our net income, we're sitting at $94 billion. So basically everything this company is making is getting used. So not good there for an investor. You want to see money being made, not zero to or basically flat net incomes. Gross margin had some nice growth, leveled off, and is somewhat declining, maybe starting to run back up higher a little bit there, but sitting right on that 30% range. Net margins, similar situation here, ran up, hit up a high of like 15%, and since has declined quite a bit. That is also a big red flag to me, is to see declining net margins. Even though your revenues are growing, your net margin, it was somewhat flat, right? It wasn't very consistent, but it was in the realm of 30% there. So not too bad. But so right off the bat, my big red flag is this net income. I mean, you look at your revs to net income is like, I don't, I'm not for me already. But revenues and gross profit year over year change. We can see growth has been relatively consistent. And this one over here includes their net income year over year, had a big jump up in their net income, which is good. They need that for sure. We can see it went from 3% to 8.3% up here. That was their jump. Return on invested capital, we're gonna have to do it the old-fashioned way. Look at this chart. We have return on invested capital right here in this line. So we went from 14, 27, 17, 22, 17 down to 6, 8, 3 to 7% currently. Shrinking return on invested capital as well. Another red flag for me. Cash to debt, because of the other red flags we got going on, an increase in debt and a very nominal increase in cash is a little bit of a concern as well. Obviously, this is a growth company, it's to be expected, but we want to see income growing. We want to see, if you're going to add more debt, we want to see the income being able to potentially cover that as well, which obviously leads over to free cash flows. Right now, we're adding more debt. We're not really gaining much more cash. So another concern. Net income to free cash flow, again, another concern of mine is we have negative free cash flow, which we'll look at in just a minute as to why it's negative. We have a big jump in net income from 94 million to 303 million, and our net income sitting down here at about negative 135 million. So they're burning through some cash just on the free cash flow side of things. So here's our free cash flow chart. Obviously peaked and then has since declined and has not yet recovered. So that'll be something to keep an eye on for sure. Share count dilution, obviously a bit of a growth company, you're going to get diluted more than likely, and they are continuing to do that. There looks to be maybe they're slowing down, but you're still getting diluted. Capital expenditures are growing. So you got growing capital expenditures, you got shrinking free cash flows, you got growing liabilities, you got shrinking net income. These are most of these charts are going the wrong way. So nothing to be too excited about, in my opinion, over here on Solar Edge. They can turn things around. Absolutely. We understand that right now is a bad time for solar anyway. These trends haven't just started. They've been going on for years now. So it's not like 2023 or in 2022, 2023 is where things, hit the pooper. It's been like this. So, and it's just kind of confirming the trend really as we continue here. But let's look at their most recent release and look through their cash flows a little bit here to understand better why they're negative. So we have over 6 months, net income of 258 million-ish dollars. So we can come down, we have stock-based comp, which gets added in. And then right here is the two that destroy our free cash flow. So we increased our inventories, which is always a red flag to investors anyway. When you see increase in inventories, it kind of tells you the business is slowing down. There's not as much buyers there to buy your inventories. And also trade receivables, which is money that's owed to the company for goods and services. So we had another big increase in that. So another $235 million increased in that, which could be a concern as well, that companies that bought your solar or your services or whatever the case may be, depending on how this is worked up, if it's an agreement or if they sold more solar to companies that aren't paying them yet, because obviously we're going to see these two things as an increase on our assets. So we see these two up here have increased, and that's an increase to your assets, but it's a decrease to your liabilities, or sorry, to your cash flows. So we want to see these shrink, because once those shrink, that shows as a positive free cash flow, because then that was money that came into the business. It's money that's owed to the company. So it's an asset, but it's also a liability because it's not money that has flowed into the company. So we want to see these companies pay for these things. Also, we want to see companies start buying from their inventories. So another couple things there that kind of show, not as a red, it makes sense, right? It makes sense because of the economic conditions and interest rates and stuff like that. So people aren't willing to uh, pay the interest to buy solar right now because how expensive it already is, and then you add another 10% or whatever percentage it may be to install solar, or to borrow the money to have these solar installed and whatnot. So, but anyway, let's continue over here to our comps. We have four other companies to compare it to. We have Enphase for solar, SHLS, and Run. I think that's Run Power maybe. So over here on Solar Edge, we're going to look at this. We have 6 or 5 different red flags, which we're already well aware of. Profit margin, very low profit margin. Return on equity and return on invested capital, both below 15%. We do have a share increase year over year, which we're aware of. This one is not a red flag because operating cash flow is actually below our net income. So I'm not sure why that shows as a red, but it should be that's okay. Nothing new to add to the list there. We have our market cap here of our companies. On the right hand side is our revenues. Solar Edge, the leader in the revenues. So we have all of our revenues, gross profit, net income compared to all of our companies. And Solar Edge, again, like we said, leader in revenues, is not the leader in gross profit and is not the leader in net income. 5-year growth rate on Solar Edge and amongst the other peers here, competitors, we can see where they're sitting there. Gross margin within the middle of the range of everybody else, but not the leader at all. Operating margin, this is where they start to shrink, obviously, and compared to everybody else. Pretty messy, everybody's everywhere there. Profit margin, same difference. Everybody's just kind of everywhere. Free cash flow, most of these companies are all negative except for Enphase. Enphase is the only one that's negative or positive, except for SHLS. They're barely positive. Return on invested capital, same thing. These are all very important numbers, in my opinion, to look at into a company and compare it to other companies within its same space. Also, if you watch the Enphase video, I did make a mistake. I put a couple companies in there that really weren't very comparable to Enphase. However, all these companies here are solar-based companies, so this is a better comp based for Enphase. So if you want to look through that, you can see Enphase is number 2. But anyway, that's a little side note. I'll post a link to the Enphase video right now. But we can also see over here on our PE, Solar Edge and Enphase are within the same area, along with these other two. FSLRs just over in left field there. So based on comps here, we can kind of see Solar Edge is not very competitive up against everybody else. They're just kind of, they've got the highest revenue, but they got the lowest profit, or not the lowest, but one of the lower profit margins. They have negative free cash flow, return on invested capital, all the things that we've already looked at in that are red flags, and we can see that based comparing it to other companies within its space, that it is also, lagging behind the competitive market. Over here on the calculators, we have a Peter Lynch valuation of $118.24 per share. One thing I want to tell you, actually, there's two things that I changed throughout these calculators is they had a growth rate of like 100 or 400% or something like that for our EPS. So I changed that to 25%. So just a little disclosure there. So I changed it to 25, and that gives us an average of 23%. Multiples comparison, we've got all of our peers that we just looked at, our competitors, and gives us a price per share of $234.28 per share. Manual PE, we take our market cap minus our cash plus our debt, divide that by our cash from operations. It's going to take this company 234 years to earn its market cap. That's the highest one I've ever seen. Price to book, we are sitting at well below our 5-year average. PEG ratio looking very good, very undervalued based on PE to growth. Grams valuation here, we have 144.16. I gave them a 1, the same as I did with Enphase if you watched that video. So we'll keep that consistent there because this is more of a growth industry anyway. Discounted cash flow valuation, we have a growth rate. I gave them 45%. Analysts have 75%. Average growth rate is negative 68%. So we can see, here's our free cash flow, which we've already kind of seen, but we can see numbers and we can see they're turning negative. They are shrinking in their free cash flows year over year, less than ideal. We know we do kind of understand why, and it's not really the business, it's really just the customers that aren't paying and their inventories. So it's just a shift within the industry that there's less buyers right now. So a little bit, it's not really the business, it's really just the industry that's slowing down their free cash flows right now. So I think that's something to keep in mind. So that gives us a negative discounted cash flow price per share. So just because we're negative free cash flow. Rule 72, we have our EPS and our growth rates here from 3 different sources. Our average growth rate is 30.62. 30.62 goes under 72, 2.35 times, 2.35 goes into 10 years 4 times. So what we're going to do is we're going to double our EPS 4 times. So we're going to take 5, double it once, 2, 3, and 4 times, which gives us basically 83. We'll put 83 in here, and we can see that gives us a fair value of $1,200 per share. But because that is potentially possible, currently I wouldn't want to put that in for my valuations to for an average multiple. I feel like that's very way out in left field. Just like discounted cash flow price per share, we might just eliminate that one. So we're going to give them a 25, or we could just leave it at 83 and just leave our DCF in there, and those will probably offset each other because this is about, we'll leave it there and see what this valuation comes out to be for an average, and then we might adjust this one and this one. So here's our summary. We have first 4 numbers are added data points, but we have 5 other numbers to go off of here to give us an average price per share. So for a fair market value of $298.85 per share. So currently trading at $129.51. 30% margin of safety, $209. Analysts have a price target of $320.43 per share. So based on the numbers we presented, I think we're close just because analysts are somewhat in the same range. So I think based on Rule 72 and our DCF, we can probably, let's eliminate that and maybe change Rule 72 to a more, fair number. So we'll put 25 in. I had 25 earlier. And then what we'll do for our DCF, we'll put 65 in once. That gives us a 19. So then that over here presents us with probably a better price tag on this company based on the financials. I got to say that. This is probably a number I'd be more comfortable with. It still is relatively close to a 30% margin of safety, even based on changing those few numbers. So that's something to see that, like, oh, wow, that's still not too terrible. So then with those 2 numbers changed, so now we have a DCF of negative 19, a Rule 72 of $382 per share. Gives them a fair market value of $172.09, 30% margin of safety, $120. Analyst price target, $320, which we already went over. So I believe that right there is a much better price analysis on this company. Let's move over to the stock chart. So Solar Edge, nasty, very nasty. This is a definition of a falling knife on this company here. And the worst part about it is where's support, like maybe you could have thought support was like 145 here. Just broke right through it. Next area of support, honestly, I think is down here at like $70 a share, or potentially this trend line. Maybe it pulls back. It's still probably got another $20, $30 left in it of pullback potential. This is something you you want to stand back and stay clear from. This is not something you want to try and buy right now. This looks bad. This looks really bad. And based on the financials, what we went over, it kind of makes sense. This is overvalued. This is super overvalued. And now it's finally decided to pull back. It's broken through this support range of $200 per share and is now pulling back. My guess, at least, is to $95 to $100 per share. If it breaks this, it's at least its next stop is about $70 per share. I would not step in front of this thing. I would wait for this thing to consolidate to find a bottom, and just let it chop around here, and maybe over the next few earnings statements on this company, maybe things start turning around. But that's something you got to keep an eye on. Look into the fundamentals, look at the forecast of what the company is saying, and see if you can't make a judgment, a good decision on whether or not this is a company that fits your portfolio, or if you just want to swing trade this company. But yeah, this is one to stay away from, in my opinion, based on how it's technically trading and the financials overall. The valuations look decent, but those valuations could shrink quickly if they can't turn things around within their company, and if the economy stays soft like this. So with the high interest rates. But that is it for Solar Edge. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.